Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello, listener, and thank you for joining us today. We are releasing our weekly update on the outlook for financial markets today. And one of the big pieces of news this week was the momentary inversion of the US government bond yield curve. Historically, every recession has been preceded by such an inversion, although it's important to note that not every inversion is followed by a recession. So it is possible to have a false positive where the curve inverts and we don't get a recession. To discuss the implications of this for investors, I have with me Daniel Lam, who runs our equity strategy team. So Daniel, apart from the yield curve, we want to talk about Russia and Ukraine as well. So as we enter the new quarter, I was obviously reading the newspapers this morning, and the headlines I was looking at was talking about how Q1 was the worst quarter for the US stock market since the COVID-induced sell-off in Q1 2020. Now, obviously, that's only 2 years ago, but still, that was quite severe. But actually, since mid-March, global equities are up over 7%, even taking into account the sell-off over the past 2 days. So what do you think is the main driver of this rebound in risk sentiment?
Thanks, Steve. Well, I think is the expectation of breakthrough in talks to end the Russian-Ukraine conflict. So you can see that oil prices has been pulling back sharply since these expectations begun. And that led to a reversal in the broader US dollar, with euro being the main beneficiary. So the market moves really show how much the Ukraine conflict is influencing short-term asset prices. Now, we've always maintained since the start of the conflict that as long as the Ukraine situation does not lead to a halt in the Russian energy exports, the medium-term path for financial assets is likely to depend on the longevity of the current economic and business cycle. And our recession monitor is actually showing that there's still likely to be a sustained economic recovery over the next 6 to 12 months.
Okay, so that's a good transition to what I wanted to talk about next. I mean, I know a lot of people are worried about the conflict, that it could have unintended consequences leading to sudden financial contagion. These things are really difficult to predict. Personally, I'm not so worried about this given the increasing robustness of the financial system following the global financial crisis and obviously the volatility we saw in the early stages of the pandemic. But my bigger concern is how this might feed into the economy. The yield curve inversion is potentially important here. How do you see the situation?
Okay, I think we need to look at two items. Okay, we need to look at our recession dashboard and what it says, and then try to check how the asset prices would reflect in terms of the yield curve inversion. Okay, so the first point is that if you look at the recession dashboard, we have 12 indicators. 2 of them are looking weaker. Okay, so they're basically both on consumption. But if you look at other items like labor data, business sentiment, corporate credit spreads, etc., they're still looking very healthy at this moment in time. Now, even if the inversion does signal the recession, okay, asset prices actually do not correct immediately. Okay, so if you look at historical returns, so on average, equities peak 12 months after curve inversion, rising an average of 18% over the period. Okay, so if you look at also the recession time, it starts an average of 14 months after a yield curve inversion. So that's two, comforting figures that you can rely upon. Also, if you look at the US financial conditions, they're remaining extremely easy today. Real rates are deeply negative, but in the past, real rates averaged 200 bips when the yield curve inverted. This is also reflected in the Fed policy rate, which, at 50 bips is still well below the 2.4% estimated neutral rate. Okay, so basically, we're not in a time when we should be overly concerned about this yet.
Yeah, and I suppose that we should sort of just bear in mind that the inversion we saw this week was only intraday, so it really hasn't signalled it yet, although obviously the curve is still very flat. So the difference between the 10-year and the 2-year yield is around 4 basis points. So that's obviously still, it is very flat from a historical perspective. Let's take the worst case situation here, Daniel, and say that the curve inversion really does, we do go inverted on a sustainable basis. So what does this mean for investors going forward? What would this mean, I suppose, for investors going forward?
Well, okay, for equities, if you look at S&P 500, it tends to continue to go up after the first inversion of the yield curve, taking an average of 12 months to peak. So the range of upside can still be very substantial after the first inversion. Okay, it goes from 8% to 34% with an average of 18%. Now, if you look outside the US, the picture also looks broadly consistent for further upside gains in equities. The data is more limited for the Euro area and Asia ex Japan. But if you look at the average figures, the Euro area and the UK historically saw gains comparable with the US at 17% and 14% respectively. XJ is actually a strong performer. It has strong outperformance of 35% on average after the first inversion.
Okay, and so what are the implications for bonds? Have we seen anything, when we've seen an inversion before, do we see any trends from there?
Okay, so historically, if you look at bonds, they have also delivered positive returns in the 12 months following a yield curve inversion. But there are also a few observations which I think one should be watching out for as well. So if you look at corporate and EM bonds, they tend to outperform government bonds. Okay, so this is basically broadly in line with our GIC relative preference for credit, which we upgraded in our latest GMO. Now, looking at the dispersion returns of each bond sub-asset class across the instances of inversion, it seems that the starting variation strongly influenced the forward-looking return. So if you look at the yield curve, given the yield curve is inverted beyond the 3-year maturity, and basically there is still upcoming Fed rate hikes leading to an upward shift in the yield curve, we don't believe that long duration bonds offer attractive risk reward. So we're looking at the shorter dated bonds there if we are to add risk, and we favor the 5 to 7 year maturity bucket. Thanks.
Okay, so let's move back to Asia. I mean, you mentioned that historically, after yield curve inversions, we see outperformance of Asia ex Japan. I mean, it is a limited history set, but that's what the data shows. China, Hong Kong stocks extremely volatile of late. I think that's an understatement, right? So, can you give us a sense of what have been the drivers of that volatility and what's the outlook going forward?
Yes, basically we've seen a V-shape move in Hong Kong China equities, and round trip there was more than a 40% 40 move this month in March last month, and basically that the main issue there was the ADR delisting, and there's also linked to any threats of China helping Russia in whatever ways. Okay, and a lot of institutional investors were selling down the Hong Kong China holdings because they deemed them as uninvestable. But on the other hand, there were strong buyers coming in. So you can see that the volume was phenomenal, right? In the middle of March, there were a few days of more than 300 billion Hong Kong traded in the Hong Kong China equities. And that's versus about 100 to 150 billion Hong Kong on a normal day. Now, what that means is that the ownership of a lot of the shares have changed hands to a few other strong institutional investors who are not likely to be selling out of them anytime soon. So what we're trying to say is that if there were to be pullbacks in the Hong Kong China equities, which we believe would be because the Hang Seng Index has been up more than 4,000 points, right, from the trough, that the pullback would be relatively limited. Okay, key technical levels we believe will be defended, and the technical levels for Hang Seng Index, if you apply the Fibonacci analysis, would be around 21,400, 20,800, and 20,300. Okay, the last one, 20,300, we think is a very strong level of support because it also matches with the gap move, the start of the gap move from the 16th to the 17th of March. Okay, so 20,300 is a key level that people should be watching out for. And we continue to believe that Chinese equities are going to outperform versus global equities because the fundamentals are looking reasonable. Okay, in terms of the valuation, it is cheap versus global equities. And the government is likely to be very supportive because they have a very ambitious target to hit, GDP growth of 5.5%. And also, of course, they are easing versus, say, the West, which is tightening. Thanks.
Okay, thanks, Daniel, for your time today. And thank you, listener, for joining us. As always, please feel to like and subscribe to our channel if you found this quite interesting. We will be back next week, obviously, with the Cut to the Chase podcast on Monday. But in the meantime, we wish you a very pleasant weekend. Please take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.